Good afternoon, and thank you for tuning in to our 2025 Outlook On Point webinar. My name's Matt Staninger. I'm the market research analyst at Oak Street Funding. I'm excited to be here today with Rick Dennen, CEO and founder of Oak Street Funding. Today we'll provide a state of the market and give an outlook for the year ahead. Thank you for being here today.
Happy 2025 to everybody.
Yeah, let's jump in, and to start, we'll talk about what types of deals we're seeing so far in 2025, and what the Oak Street Funding loan product do you see being the most useful or best leverage for growth in 2025, following industry and market trends we're seeing.
You know, we've got a lot going on from a geopolitical environment with the new Trump administration coming in. And I think with that, with the reducing rates, tax changes, things like that, in the industries that we're in, we're going to continue to see, consolidation. I think there's still some deals happening. Some industries are a little bit more mature than others in that consolidation. But I still think that, throughout 2025, there's going to be a lot of M&A activity, which is really, some of the PE funds and some of the liquidity that has existed for so many years. They still have to put money out. They still need to do transactions, and that consolidation is going to continue. Some in certain industries more than others.
Right, M&A looks like it'll continue to be robust, of course, as you were mentioning. We really had a pretty strong M&A year in 2024, and with the new Trump administration, things are looking like they likely will become even more robust here in 2025. And, of course, as the Trump administration continues, we'll really start to see how subversive their deregulation policies are. Some laws end up being a little bit more lax in the M&A space. And again, emergence with PE firm, more mature in some industries than others. And really, we should continue to see that momentum out.
Yeah, I would agree with you. And that deregulation, I think, I don't think that will impact the industries that really Oak Street's involved with, but one that it could impact is banking. Already heard from different investment bankers that, the people with their eyes open, ears open, looking for opportunities, has already opened up. And, everybody's anticipating that deregulation as a result of Trump. And I think that you will start seeing some bank consolidation again, which has slowed down for the last couple of years.
Right, that should be ramping up again. You mentioned some tax changes before as well. We, of course, do have the TCJA expiring here at the end of 2025. We do, of course, anticipate many, if not all, those policies will continue on. But at this point, there still is sunsetting for things like the qualified business income deduction and the estate and gift tax exclusion, which may impact some of our smaller businesses we work with.
Yeah, I think you're spot on there. I think with those expiring, again, everybody's anticipating that those will be extended. So I don't think there's really much more to add there, whether there's going to be at different rates or different timelines, but certainly think they're going to be extended.
Thanks for that. We'll look forward again to how those predictions play out. What role do you see the potential declining Fed interest rates playing in 2025?
Some deals will be looking to be refinanced out at a little bit lower rate. I'm not anticipating even a 100 basis point drop. We might see 2 or 3 25 basis point drops during 2025. But that with the rate drops that we had in 2024, I think it creates opportunities in a lot of different areas to either refi or, the returns that you get from those lower interest rates. I think people just mentally start thinking, hey, we're having a rate decline that will help us, and it'll continue to drive M&A as well.
Right. I think you're spot on there. I really think 2 to 3 rate cuts seems like the right number. Right now, the market's actually only predicting 1 with how strong of numbers we've seen. The early year jobs reports have been very strong.
Yep.
Inflation started to look a little bit sticky here. But really, January through March last year, we had very high inflation numbers. So we could be benefiting a little bit from those to see a little bit lower inflation beginning of the year, that might help push the Fed to be a little bit more dovish than what they're currently positioning from the summary of economic projections that they have produced in December.
Yeah, and no earnings really start this week, next week, earnings releases from different companies. And so I think we'll start to see how some of those things are playing out. But I agree with you. I think those numbers are causing things to be propped up a little bit longer. And, the need to reduce those rates is less and less. But let's see how that plays out.
Right. The Fed, of course, says that they also are not an anticipatory type of organization. So they aren't necessarily playing into what they believe Trump policies could become. But we also know that that could be an additional layer for what ultimately happens this year.
So I agree with it. I agree with it there. So lot to happen in 2025 as, with Trump coming in and having control of the House and the Senate as well. I anticipate that a lot will get, pushed through in 2025, versus, the end of his term and what's that 2028, 2029. So,
right. We'll see throughout the year how deep those can be pushed, if any of them gets pushed back from the courts. And really will set up to see how, especially the next 2 years, while both sides of Congress are Republican controlled, what they are hoping to attain and what they actually can attain.
Yeah, I agree with you.
How can business owners differentiate themselves to overcome competition?
It's interesting. I literally had a quote at my desk. I think it was from the CEO of GE who said, if you can't compete, don't. It's pretty simple and pretty profound. To me, you've got to be able to differentiate yourself. And, in the industries that we're in, the one way that we always talk about differentiating ourselves is just the level of expertise we have. We understand the markets. We understand the structures in the market. We understand the industries and what the structures need to be to support that. We're very good, I think, at listening to our customers and, really trying to understand what they're trying to accomplish with their strategy, what their strategy is, what the timelines are, what's the strengths and weaknesses of their people, to put the right structure in place that matches all of that. If you can do that, in a document, which is hard. And we know that's going to change. But when I think about differentiating, in the industries that we're in, it's clearly the level of expertise. I met this morning with a gentleman that runs a private equity fund, and we talked about being an inch wide and a mile deep. And that's really kind of a strategy we've had here, since inception, and one that I've kind of also tried to take to the bank. Because banking is a very commoditized product in a lot of situations. And it's, as I talk to the different teams, it's, how do we differentiate ourselves? And you really need to have an expertise or a specialty, whether it's an industry, whether it's a product, for example, like an ESOP or a succession loan. You've got to have an expertise to be able to differentiate yourself in the market. And, we've seen that over the years. The smartest customers we have, it's not about 5 extra basis points on rate. It's about what structure. It might be we have a better advance rate or a lower origination fee or something like that. But it's the right structure that matches what they're trying to accomplish in achieving that type of timeline. So, I really do think specialists are the key to the future of banking. I've seen recent reports on just this week on Goldman Sachs talking about the fact that they think private credit is really the future of a lot of the C&I banking, which is really where Oak Street's been for the past, 20 plus years. And I think that kind of goes, that private credit is going to support very specialized lines, whether it's consumer, whether it's commercial, anything in there, it's going to be specialized companies and leadership teams And I think that's really the future of banking.
That's a great way of looking at it from the banking industry. I think that applies really to all the industries that we serve as well, where you need to make sure that it's a tailored approach. You need to understand what your people are, what their specialties are, and take advantage of that really between your mission and vision, as well as your value statements, and providing that personalized experience, providing what you're good at is what's going to set that differentiation. You have to realize that competition, it might be company ABC that you're competing against, but it's also the outside factors. It's whatever people perceives as letting there be other opportunities. So of course in banking, we talk about private credit being one realm. It might be more of a traditional lending that they're going to, or it might be that now doesn't feel like the right opportunity, so we just decide not to lend at all, or we decide not to invest at all because the opportunity doesn't feel right for what other outside influence there is. That's still a competitive force there. So,
I mean, you bring up some really good points, and when you think about Oak Street and just how this company has evolved, two things really I wanted to mention was every single year we take, the senior team and we have them fill out independently a SWOT analysis. And it's something that was taught to me by my predecessors. But it's an assessment of really what you're good at and what you're not good at internally and externally. And really, how does that impact your strategy in the following year? And, a couple of years ago, we're always looking for different ways to expand and grow. And so we've looked at different industries, from energy to third-party administrators to, a number of different industries, distillery lending, for example. And as we've looked at these, we put together, we've assessed the opportunities. We've got approval from the banks. We might do a loan or two, and we assess, and it's kind of a crawl, walk, run approach, but we kind of assess, do we have an opportunity to be experts, to be credible in the industry? Is there a good enough, market sizing to be able to go after that and build a good, solid portfolio to make money? And for us, that's probably like, if we can't generate $25 to $50 million in a portfolio, it doesn't make sense to us to really do. And we're constantly shifting where we spend our energy and time. And we get into things and we try them. And if they don't work, we back out of them. If they do work, then we accelerate those. It's that, like I said, that crawl, walk, run. So that's something we've done here for ever since every single year that the company's been in place. So I think it's really important that people do that, but they have a true assessment of what they're good at and what they're not good at.
I agree. I think that's a very valuable piece that we do here. I think that's a great tip for others as well. And as we're thinking about considering those investments to make, what are some of the things someone should look for when determining the value of business they're looking to buy?
For me, I'm in the businesses we're in, but I've said it for even before I started Oak Street, it's people. It's people. And I've seen businesses that you look at the business model and they're really not, a model that excites you. You know what I mean? And you're not like super bullish on it. But then you look at the management team and you look at their passion and you go like, these guys they're going to do well. But on the flip side of that, Matt, I've seen the same thing where you've seen a good business model and you look at the management team and you're like, well, these guys are bored. They're not really excited about it. They've got 3 different passions that they're focusing on outside of this. Like, I'm not really sure this is going to be successful. So, for me, when I think about that, I'm going to always start with the people, okay? And if the people, like, that's a binary. If that's not yes, check the box, then you just got to move on. And we've done that in a number of situations where you underwrite a deal, the numbers check out, but then you just don't have the belief in the management team, and something will trigger it to say, we can't move forward here.
I think we're starting to see a lot more of that in the industry as well. we're starting to see, I've read multiple articles recently talking about private equity getting a little more selective and who they're choosing, not just from a numbers perspective, but from a culture perspective. So I agree. I think matching up with the right people and making sure that the business models don't just align with whenever you're first looking to acquire them, but what happens when there's a little bit different of an eye-to-eye 12 or 18 months down the road? Are you going to be able to work through those in a very constructive manner for the business to be able to continue operations in the best possible way?
Yep. Yeah, I agree with you there.
So how should someone value a startup agency or a broker compared to an established insurance agency?
It's going to be different in every situation. The startup, if you look at a startup, but it's somebody who's done it before, that's going to lend you a little bit credibility. The bottom line, Matt, you're going to look at a piece of paper, and what's your probability that the management team is going to be able to achieve those numbers? That's going to be on those types of startups. That's what's going to be critical in determining evaluation. I think in a lot of instances, it's hard to argue, other than like a book value on a pure piece of paper. And I know because, that's what I did. The original business plan is sitting in my office, and you want to argue it's more than just book value. But until you go out and prove it, it's hard to justify that to somebody to say, okay, we've put in $1 million and the business is worth 10. Would you invest in something like that? If somebody gives you a piece of paper and says, hey, here's our model, I'm putting in this amount of cash, but I want you to pay 10 times that, and we really haven't done anything other than write a piece of paper. And that's hard to do. But in a lot of situations, that happens. But there's going to be other circumstances that the management team just left, or just their non-competes just ended and they can restart the exact same thing they've done for 20 years. That might have a lot to do with it. Or they have a customer that's locked in, that's going to generate a lot of revenue in the first couple of years, or they've got a product that's just off the charts better than anybody else's. So, things like that are always going to be considered. Valuations, as we talked earlier, there's just a lot of capital at play that needs to be deployed. And I think in order to do that, those valuations do get sustained. But there's a certain point, especially as rates rose, there's a certain point where the multiples can't continue to go up. There's only so many synergies that can occur. And I think you've got to be very disciplined in saying, in the good ones, the aggregators, that we talk to and deal with, and the PE guys that are, really good and experienced, they're very disciplined in how they go through and value a business and how they structure a business, making sure the management teams are going to be there. And I think being disciplined and experienced is very helpful in these times that could get, as rates are declining. I think it'll generate activity. Stay disciplined.
I think you bring a few really good points there of, first of all, going through how long they've been there, with how experienced their people are, because have they actually been through different cycles in their industry? Of course, we've had very different cycles the last couple of years, whether you're talking about health versus property and casualty versus a specialty line. And then you also brought up...
Yeah, and to think about in the insurance space, we've had hard and soft markets over the past, 23 years, at different points in times in different industries. In the RIA space, we've had, that market go up and down from, the declines in the real estate in 8, 9, and 10 to the pandemic, but it continues, it might have a dip, but it continues on. So you get these different cycles in these different industries. Do you believe in the industry and kind of what's going on? Right. But there's a lot. There's some macro factors that play into this for sure.
Definitely. As far as multiples go, I completely agree with you as well. We seem to be starting to get that deceleration toward what should be a plateau phase at some point at these multiples. That, like you said, they can't just continue to keep going up. As they've steadily risen, that rise starts to slow a little bit now.
Yeah.
All right, going into another area, what can businesses do today to prepare to make a deal and take action when the time's right?
Oak Street is, we've sold the business 3 times. The key to me is operating your business every single day and trying to innovate, trying to be efficient, trying to use technology, in finding the right people. And like that can't change. Like you got to be on that stuff and executing on your business, driving your business, staying focused in it every single day. And I think if you do those things, one, you're going to be prepared for it. There might be some things that you do in your final year before a sale, but it's really not, hey, I've decided after 30 years I'm going to sell in 6 months and we've got to change everything to get ready for sale. If that's the case, I'm going to tell you you've probably not been the most efficient or productive in the past, 5 years anyway. And so you've got to really be operating on a day-to-day basis. It's not something you can just turn a light switch on and off. While M&A is picking up, I also think the amount of time it's taken to get a deal done has probably slowed down over the past 2 or 3 years as well.
I would agree with you there. And I think that really alludes to what we see a lot in the investment advisory space of needing to make sure you have a succession plan in place years in advance, even if it's not necessary that you're planning a sale for a specific set of time.
Yeah, I agree with you. You got to be thinking about that. It's interesting at the bank. Every year, I've got to document the succession plan, for me and my management team. And I look at that. I didn't have to do that as I was building Oak Street and as we were selling. But, in a bank, you've got to do those types of things. You've got to document. It's reviewed, it goes to the board. There's like those types of things that are a little bit more institutional than when we were independent. But it is, you gotta think about it, and but just run the business the best you can every day. And if you put those disciplines in place of, the SWOT analysis, the strategic planning, a good management process of meeting with your team, accountability, engagement, it's going to play out.
As you mentioned, Oak Street's been through a sale process 3 times. How do you actually know that time is the right time?
We did have, financial sponsors for each of those 3. So, the timelines, I would say, they're never set in stone. But, like, especially on the last 2 funds that were involved, like, the fund have 10-year limits. And so, you're going to be out in a certain period of time. And strategically, we put together each of those 5-year plans. And, you modify those every 3 to 6 months, and you look at those plans, but you put those plans together to say, this is what we want to accomplish in 5 years. And then it's 4, and then 3, and then 2. And at the same time, you're assessing what's going on in the markets. What's going on with multiples. For ourselves, just like as we look at our customers, we were assessing multiples all the time. We are assessing who the buyers are, how those multiples are changing, what's going on in the industry. And so, then it became, we were really fortunate to have the partners we've had. The last one with Angelo Gordon was the partners that we had that were just phenomenal, and really enjoyed them. They were beneficial to the organization and brought, some good resources to us and challenge us strategically on, we want to expand into here. It's like, stay focused. We want to go here, stay focused, or then it's, okay, we're here. Well, had you guys thought about this? And it was that constant challenge that I think made our management team better. And ultimately, we've had really good successes for each of our partners.
A couple of really good points there, talking about how you needed to stay focused on what does 5 years look like from now. Then it became 4, then 3, so on. How does that differentiate whenever you're in more of the earlier side of your ownership and you might be a little more growth minded versus being later in your ownership and you're preparing for retirement or you're preparing for your next chapter outside of the industry?
For us, growth was always top of mind. And I think when you look at the multiples and what somebody might pay for you. Like, growth is probably one of the larger, it probably is the largest variable that will impact that multiple. If you can prove you can grow at 40% a year, right, they're going to pay more for it because the upside's that much greater than if you were 40, 30, 20, 10, 5. You're not going to get the same multiple. So growth was always top of mind for us, and we were really fortunate that, the industries that we were in had a lot of activity going on, but then we expanded to other industries that generated that growth, like I said, and were able to get us that continued high growth levels. When we moved from insurance to RIA exceeded that portfolio of what we started in insurance and only did exclusively for 12 years. And that's just a great industry to be in. The CPA one is one that's a little bit newer as far as consolidation, but it's providing us tremendous growth and opportunities. And as we look to 2025, there's other industries we're looking at that will allow us to continue that high growth rate, which, the bank appreciates, as long as we're doing it prudently, which we always have. Credit is the most important thing. You can't be building portfolios that are going to have losses down the road. So credit is always the most important thing as we develop these lines, and making sure we kind of box, what the risks are. But that starts with expertise, understanding the risks, making sure we can box it, structure around it, and find the right partners.
Absolutely. So continuing to grow there, what kind of things then would our owners in the insurance, the RA, the CPA space need to be aware of and need to be doing if they're trying to get a deal done by the end of 2025?
I would start the process now, whether that means probably means interviewing and talking to a number of investment bankers to gauge what's important right now in the industry, when the best timing to go to market would be, who are the best people that have gotten the most deals done in these spaces, and trying to find that specialist on who to go to and who would be interested. And I think that's a great place to start. You can't think you can do it alone as a business owner. I would recommend, unless you're a very small organization, finding an expert investment banker that knows the industry, knows the buyers, knows how to position you well, and can give you some of those tips. But you can't just stop all your marketing expenses and cut your people, because that's just going to be very obvious. Buyers today are very educated, very smart, and they're going to know what to look for. The ones that are going to pay the highest premium for it, they're going to know exactly what to look for in the industry. So, again, operate your business the right way, effectively. Pick a strategy, management team, and execute.
Definitely keep those sound operations. There is still time to be able to do this process. Of course, as you get a little bit bigger, it's going to be a little bit more drawn out, a little more complex than what some of the smaller deals may be.
Yeah. I think once you start and hire an investment banker, you're probably talking still, 3 to 6 months on a processor. I would agree with that.
Well, let's shift gears a little more to the outlook for this year. Where do you see the CPA, the RA, the insurance industries progressing through the rest of 2025?
So like I said, I think the CPA industry, in its kind of consolidation, is newer. That phenomenon is occurred more recently than the RA space and certainly the insurance space, which has been going on for some time. We're seeing a lot of the same players go from one to the other. So, they know the process. So those multiples started small in insurance and grew as it was more, it became more prevalent and institutionalized. Same thing with the RA space, multiple small, but the curve was quicker to get to that multiple. And I think the exact same thing is going to happen with CPA. It's a cash flow, intangible asset type business, which is built around relationships. And the multiples are still relatively small right now. But I think very quickly, those multiples are going to get right to that level, that the aggregators are willing to pay. They understand, the synergies, what they can wring out as far as expense, what they can use technology for, how to leverage their people better, all those types of things, a little bit of a replication. So, I do, as we've talked, expect that consolidation to occur with all of them, but the highest rate of acceleration is going to come from CPAs. And I think the other two, probably the next highest would be RIA, but we're still going to see, I suspect, more deals in insurance in 2025 than we saw in 2024.
I agree. And 2024 was a record year for a couple different areas. Insurance finished right on pace with what 2023 was. RNA saw a little bit of an increase. I think we see record years for both of those most likely this year. And I completely agree with you with the paces that we're seeing. Insurance took a little bit of time before the consolidation really pushed. We've seen it pretty saturated for some time at this point. It's definitely saturated now in the RIA space where we're seeing a lot of buyers come in. We've got those multiples pushed now. And it does seem to be the pace is happening a lot more quickly in CPA.
You'd be surprised, though. I still receive calls from aggregators, new aggregators, coming into the insurance space. So insurance experts that maybe have been out for 5 years that are coming back in saying, you know what, I can consolidate this specific market. You know what I mean? And be an MGA and pull together these agencies. I still see it. And sometimes I'm amazed and I'm like, do you understand that these multiples are at all-time highs? But I think some of their deals, because of their expertise, they can still drive the multiples down because of their expertise and sell, hey, come with me. You're the platform. We'll consolidate these, and you've got, upside opportunity as well.
Right, and we're continuing to still see fresh people going independent too. We have more registered investment advisors than we did a couple of years ago. We have more independent insurance agencies than we did a couple of years ago. So we're really seeing even more opportunities out there. Even with the aggregators consolidating the market, we're continuing to see new opportunities arise.
Sure.
All right, what are the most significant potential disruptive forces, whether that be from regulation, technology, rates, any other outside factors? What do you see impacting businesses most in 2025?
What's just behind us now is, what's going on with the wildfires out in California. The billions of trillions, and whatever that number is, you could read a different report to get a different number. The impact of the insurance companies paying that out obviously is going to have an effect of the returns of those companies. Where that's going to probably fall on is, right back to government. State government, I'm not sure, but it'll certainly have some federal aid to rebuild what's going on. And I think it's things like that might impact, a carrier or an industry. Carriers have been trying to pull out of there, as you understand it, you read on it, for the last couple of years, predicting this was going to happen, which is amazing. But other than that, you mentioned a number of them. I think those are all potential macro risks. But the interesting thing is, like in the RIA space, even with the pandemic, and you saw the market just crash and burn. Like if you look at that where it is now, like if it was on a 7% slope, like it literally is right on that line today, as if that never happened.
Yes.
We've talked about the hard and the soft markets in insurance, and that's been going on for hundreds of years. So those things are going to happen. But when you look overall in the economy, like I still feel like the economy is strong. But people are spending money. Inflation is obviously high, causing some impact. Within the CPA space, I think that's, regulation could impact that. Technology has helped it. That is a resource-intensive business. that you need people. But, the economy has been good. And, generally, I think, and these industries are very resilient.
Right. You mentioned talent a lot with CPAs as well. Couple of things there. We're seeing the industry try to start being a little bit more lenient, a little bit more willing to adjust on how CPAs are actually becoming CPAs now. Couple of things we saw, changes in the CPA test last year. Now, Ohio, I had seen just recently change their 150-hour rule for CPAs. So the 150 hours is still an option, but now they can have a regular bachelor's degree with accounting, with all the accounting requirements done, 2 years of work experience, and pass the CPA exam. Or they can
have less than 150 hours.
With less than 150 hours.
Yeah. When I came out of college back in the 80s, anybody's that old, that's what it was then. I think it was like 123 hours plus, the required coursework in college, and then some experience, and you could sit for the exam. But the exam, you used to take it one day, all 4 parts of the exam. Then it went to 150 hours, which made it more stringent and harder. But you could take the exam, any time of the year, 1 part at a time. So I was unaware that they're coming off that 150 hours in Ohio. I don't know if that'll be something that continues. I don't think it exists in Indiana. I know people still getting their 150 to be able to sit. So
Ohio's the first state to do it. Just got signed in January of 2025. It takes effect January of 2026. So we'll see it. It's also
the purpose of them doing that is to bring more people to the industry.
Absolutely. The talent has been a huge issue for the industry, and it continues to become even a larger issue.
Yeah.
You also mentioned about the LA fires going on. Of course, reading a different article every time you see a different amount in there. That forebodes a really challenging year that could potentially be happening in the PNC side of insurance. What other impacts do you believe that will ultimately make on the independent insurance agency level for the year?
I'm guessing from an independent agent, outside of California, when it's going to be relatively consistent. These insurance companies are always trying to assess their risk and balance that risk of what they cede off to reinsurance companies, what risk they're willing to accept, how they structure their deal. I was with our former CFO, Todd Gray, in Chicago for breakfast yesterday, who runs a couple of different insurance carriers out of Chicago. And we talked about just this, and that there's different companies that they have that they cede the risk off. There's others that they take. But I think an independent agent, most of them, the non-captive are going to have a number of different markets and opportunities that they can sell into, but outside of California, I think they'll be consistent.
And we also talked a little bit about technology. So technology advancement is huge in every industry right now that we serve. As AI continues to grow, how do you think that'll be integrated and utilized in the industries we serve in 2025?
I think it's just evolving. I think AI will be beneficial for these insurance carriers to evaluate risk and things like that. I think it'll be tested against some of their older ways on how they evaluated risks with, modeling and different things. But I think it's in its infancy stage, but it's going to have, I think, a dramatic effect on how people utilize AI to do anything from, determining what their losses are going to be in fires like this, determining what the risks are, how much risk take relative to their capital position, to, planning your vacation, doing your financial planning versus having a financial planner. It's those types of things that I think could have some impacts on some of our industries, but I think it's early stages. but it's not something that's going away. It's something that's just going to continue to get better.
It seems to be emerging more and more. I agree that seems more down the road. I think there may be some increased efficiencies. We may see short term. We may see some of your manual tasks becoming more automated. Maybe not fully automated, but cutting down on those times that you're working on some of those mundane, very manual tasks. So we talk a lot about the talent shortages affecting CPA and RA industries. I know we got into this a little bit already, but what can business owners be doing in the meantime to attract top-tier talent to their firms?
In my opinion, you got to show if you have that growth, if you have that opportunity, I don't think you have to be the highest pay. I think you've got to be, in the market, so to speak. But if you've got an environment that is energetic, engaging, and the people are having fun doing what they're doing, that can attract a lot of different people versus, other places. The return to work thing is really interesting because it's hard to establish your culture if everybody's working remote. It's hard to show the energy. It's hard to show the excitement, the passion, if everybody's working at home. But you can't ignore return to work. I think certain organizations have done that. Certain organizations haven't. At the bank, and I'm a believer, like being together certainly will deliver the best results. But that time together could maybe be consolidated in 4 days versus 5. Where you had 3 meetings a day for 5 days. Well, maybe you have 4 meetings a day for 4 days. You get the same meetings, the same impact, and people are energized, and maybe you could attract talent because you work at home 1 day. So you can't ignore it. But where I think it is difficult with the return to work, if everybody works at home, I think the younger generation, if they don't get in and understand the business and the impact of the culture and learn from the more seasoned people, they could be missing out on growth opportunities for themselves in their careers, leadership opportunities. And, so I feel real fortunate for where I came from in public accounting and seeing different teams and how those teams work together and the team that we have here and how it works together. I'm older in my career, so I've been able to see that. But I think it's really important as you assess credits in those management teams to lend against, a PE guy to buy, like certainly seeing those different teams over the past 30 plus years of my career, it's beneficial to see when you go visit somebody for diligence, to see how those teams interact and assess how effective they communicate, assess, their engagement, their interest level, how much they know about each other, how much do they know about what each other is doing? Do they align on strategy? Or are they just coming together for the meeting and one's in LA and one's in New York and one's in Florida, and they haven't seen each other for 3 months other than, Teams calls and WebEx. So I think it's, being face-to-face, there's certain benefits too, but you can't ignore the return to work. Hours of working from home, however you want to define it, Matt.
Absolutely. I think it really depends on the firm, what their culture that they want to identify is, and making sure that they align with the correct people for that.
Yeah, I would agree.
At the end of 2024, we talked about strategic planning in 2025. Do you have any tips for business owners to help them mitigate potential risks that could derail their strategic plans in 2025?
I mean, the risks we've talked about, I think the biggest risk is not having a plan. And we talked about doing the SWOT analysis, which translates then into what are we good at? What do we want to accelerate? What do we want to fix? what's going on in the markets. So doing that with your management team, I think, is assessing all of those. I think it's a really wonderful way to go about developing a strategic plan.
And I think that goes to sticking with the plan, but still knowing that the unexpected is going to happen sometime over the course of the year.
That's a given. You know what I mean? The first thing you know when you put a plan together, it's wrong the next day. Something's changed, and that's where you got to be fluid. But, that's part of the process, too. I don't expect it to be the same.
And that's both internally and externally, where people may suddenly be leaving, some people may be coming in that weren't quite what you expected, or we may be talking about some of the 2025 anticipated impacts. What's going to happen with tariffs? How is that going to affect the macroeconomy that will end up trickling down, affecting businesses?
Yep.
All right, to wrap up and bring this back to where we started, can you provide final comments on the market and some signs to look for that those listening should be aware of?
I think I would just watch what's going on with rates. You talked about inflation numbers. Is inflation going to slow down? I think those are critical to determining, obviously, the changes in interest rates. And I think those rates will drive a lot of different things. But, all in all, I think the economy is strong. I think the industries we're in, there's going to be good and bad that's going to occur. But again, they're stable industries. They're not going to disappear. So I am bullish on 2025.
I agree. I have the same kind of outlook as you. We know what the Fed has put out for their summary of economic projections. We know that they're predicting another 1.5% to 2% GDP growth. Ultimately, we'll see what plays out. But I'm with you. I'm very optimistic on what we're seeing, especially within our very stable industries we serve.
Drake, I appreciate your time, Matthew.
Likewise. Thank you for being here today and sharing your insights for our audience. Thank you to those who tuned in and submitted questions. We appreciate your continued viewership. Stay tuned for more from us here at Oak Street Funding with new content and new guests. Thanks again.